Bill Hwang, a hedge fund manager and experienced stock trader, sat atop one of the biggest and perhaps least known fortunes on Wall Street. He had amassed billions of dollars through stock trading over the years, but his luck ran out and almost overnight, he has lost all his wealth. In this video, we're going to discuss how this hedge fund manager lost $10 billion in a single day, Bill Hwang. The video is going to be amazing, so make sure you stick till the end. Bill Hwang is a Korean-born New York-based investor on Wall Street. It's a tale as old as Wall Street itself, where the right combination of ambition, savvy, and timing can generate fantastic profits, only to crumble in an instant when conditions change. He completed his MBA degree from Carnegie Mellon University and started working as a salesman. I always blame people who set up UCLA in such a nice neighborhood. He told congregants at Promise International Fellowship, a church in Flushing, a neighborhood in the New York City borough of Queens, in a 2019 speech. "I couldn't go to school that much, to be honest." Hwang began his career at Hyundai Securities in New York, after which he worked at the now-defunct Peregrine. At Peregrine, he met Julian Robertson as one of his clients. His major career breakthrough came in 1996 when he was hired as an analyst at Robertson's Tiger Management, a hedge fund company established in 1980. At Tiger Management, Hwang was responsible for investing money received from clients to hedge against the unfavorable market condition. Colleagues say that he had an impressive work ethic. He kept his desk clean and organized so that he can focus on the job at hand. They say that Robertson, the owner of Tiger Management, had called him the Michael Jordan of investing in Asia. "I'm just very sad about it," Robertson told Bloomberg News Service. "I'm a great fan of Bill, and it could probably happen to anyone." Robertson closed his hedge fund in 2000, but handed Hwang about $25 million to launch his own fund, Tiger Asia Management. Hwang's Tiger Asia mainly specialized in tech and media shares of companies in Asia. He was able to attract wealthy clients located in Asia, which grew to over $5 billion, billion belonging to foreign investors at its peak. "When we create good companies through the capitalism that God has allowed, it enhances people's lives. God delights in those things," Hwang said. The annual returns through 2007 were a record 40%, allowing the company to gain wealth and reputation. Tiger Asia suffered heavy losses in the global 2008 financial crisis. Trading losses during the financial crisis had humbled him, and the U.S. criminal conviction of his firm for insider trading had knocked Hwang out of the hedge fund game completely. He closed his Tiger Asia hedge fund, which specialized in Asian internet and media stocks, and lost all his clients. In 2012, Tiger Asia Management and Hwang paid a $44 million settlement to the U.S. Securities and Exchange Commission in relation to insider trading. He would soon be banned from trading in his favorite market, Hong Kong, for 4 years, and the other Asian markets in which he specialized, Japan and Korea, did not hold the same opportunity. "I had really a bad business problem, and I knew no matter how much money I had, and I had a lot of money and a lot of connections, but they couldn't help me," he said at a Hawaiian Islands Ministries event. "So one thing I knew is I had to go to the scripture." At age 48, Hwang turned the firm into a family office, renaming it Archigos Capital Management in early 2013. Little regulated family offices are created to manage the wealth of private individuals and their families, as opposed to hedge funds, which traditionally manage money for outside clients such as pensions and wealthy individuals. He borrowed billions of dollars from Wall Street banks to build enormous positions in a few American Chinese stocks. "He never struck me as a big risk taker," said a Korean businessman who worked with Hwang in New York. "But when you hear the news, you wonder what happened, that he built such a massive fortune and now it's being unwound so quickly." The prime brokerage units of major investment banks, including Goldman Sachs and Morgan Stanley, had arranged for Hwang to invest enormous amounts, as much as $50 billion, in stocks using derivatives instruments known as total return swaps. One of the biggest mysteries in financial markets has been, how did Hwang manage to become one of the biggest traders on Wall Street after closing his hedge fund in 2012? Hwang's Archigos capital was the subject of margin calls that reverberated through financial markets in recent days and cost investment banks like Credit Suisse and Nomura Holdings between $5 billion to $10 billion. JP Morgan analysts estimate. But how did Hwang amass a $10 billion fortune that he could use as a collateral for his total return swap positions in the first place? The answer is that in the years after he closed his hedge fund, Hwang went on an incredibly successful trading run. Bill is not afraid of leverage. He does so much work on the companies he invests in and is always hedged, and the companies he invests in are generally high quality, says a person familiar with Hwang's investment operations. He truly is one of the world's best investors. He compounded his personal wealth at enormously high rates of return by investing in a few high-flying US internet stocks like Netflix, Amazon, and LinkedIn, and holding on to them, a person familiar with Archigos operations says. Hwang constructed a concentrated portfolio of internet stocks which would eventually include Chinese stocks listed in the US, and he kept the portfolio hedged, making Archigos an attractive client to banks as the value of its assets exploded. Netflix's stock has increased tenfold since 2013. This year, Hwang appears to have dialed up the leverage and risk dramatically. He was involved in momentum trades and the stocks seemed to soar almost irrationally. Hwang had exposure to the stocks of New York-based media companies Viacom CBS and Discovery, which saw their shares increase by 169% and 157% respectively. In the first 11 weeks of 2021, he was long GSX Tech EDU, a Chinese online tutoring service with a stock that tripled over 2 weeks in January. By mid-March, Hwang was the financial force behind $20 billion in shares of Viacom CBS, effectively making him the media company's single largest institutional shareholder. Hwang has spoken frequently about his faith and business and co-founded a charity, the Grace and Mercy Foundation, which supports the poor people. The risks the banks and Hwang were taking became clear in recent days as the shares of some of Archigos' concentrated positions, like GSX Tech EDU, declined almost simultaneously. The stock of Viacom CBS crashed abruptly last week after the company issued $2.6 billion of shares. Another stock associated with Hwang's portfolio that tumbled last week was Chinese e-cigarette company RLX Technologies. At the same time as some of his concentrated longs were suffering, the broader stock market was reaching all-time highs, which would have hurt Archigos' broad short hedges. It remains unclear how much of Hwang's net worth will be left when the dust settles. Through a spokesperson, Karen Kessler, Archigos issued a statement saying, "This is a challenging time for the family office of Archigos Capital Management, our partners and employees. All plans are being discussed as Mr. Hwang and the team determines the best path forward." The meltdown of Hwang's firm had ripple effects. Two of his bank lenders have revealed billions of dollars in losses. Viacom CBS saw its share price halved in a week after the shares of Viacom CBS had nosedived last month. Banks demanded that Archigos repay the loan. The company was not able to repay the loan, due to which the bank took ownership of the assets and sold the company that wiped Hwang's net worth of about $20 billion. Hwang's company, Archigos, had defaulted on credit it had obtained to fund the billion-dollar portfolio. The Wall Street Journal reported that Hwang lost $20 billion over the course of 10 days in late March 2021, imposing large losses on his bankers, Nomura and Credit Suisse. That whole affair is indicative of the loose regulatory environment over the last several years, said Charles Geist, a historian of Wall Street. Archigos was able to hide its identity from regulators by leveraging through banks in what has to be the best example of shadow trading. What is your opinion about Bill Hwang? Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to subscribe to our YouTube channel, hit the bell icon for more updates and notifications. Stay safe, and we'll be back soon with another video.